Hi, yes, we've reached chapter 12. Oh, I should have said howdy. Chapter 12 is all about the statement of cash flows. Now, a little background. In 1987, the Financial Accounting Standards Board issued statement number 95, Statement of Cash Flows. This statement establishes standards for cash flow reporting for all business enterprises. It requires that a statement of cash flows classify cash receipts and payments according to whether they originate from operating, investing, or financing activities and provides definitions of each category. Now, you'll remember that the income statement and the balance sheet are both accrued statements, right? There's no cash involved here other than the cash balance on the balance sheet. But in order for a business to function, it needs cash to pay bills. I've always told my students, and I probably mentioned it here once or twice, you could have $1 million in accounts receivable on your balance sheet, but if you're not collecting that money, you're going out of business tomorrow with $1 million in receivables because you can't pay bills with that. So the statement of cash flows was developed for businesses to be able to more discreetly look at their cash situation. How is it working? It essentially says, where does cash come from? Where is it going? Right here. Cash flows are classified in 3 categories. So we have 3 basic sections for the statement of cash flows that determine where the cash is coming from and where it's going to. We have operating activities. Of course, that's anything having to do with creating revenue, with running the business. Investing activities, where we take cash and we give it to someone else as an investment, expecting a return. Or financing activities on the other side of investing, where we're borrowing money from a lender or from an individual in order to do something in the business, maybe to expand our business or to temporarily pay bills. A separate section at the bottom of the statement of cash flows talks about significant non-cash investing and financing activities. Those would be things like taking out a mortgage to buy a building. So here's the basic format for our statement of cash flows. Again, we have cash flows from operating activities, and then we have a line that says net cash inflows or outflows. So that's the net for operating activities. Cash flows from investing activities and the net cash inflows or outflows from there. And finally, the financing activities, giving us the net cash inflow or outflow from financing. We then have a net increase or decrease in cash. We bring down the beginning cash balance for the year, and that gives us ending cash balance. And this number should match with the cash balance on your balance sheet. Now, the thing about the statement of cash flows is it can be used for a lot of different things. One thing might be if you see that you have a cash outflow from operating activities and you have a large cash inflow from financing activities, what that's telling you is that your operations aren't supplying enough cash to pay the bills and you're borrowing to do that. Now, short term, that I suppose can work. But over the long term, you can't continually borrow to pay the bills. Operations is supposed to supply the vast majority of cash that's used in the business. And here's that last line, the schedule of non-cash investing and financing activities. So that's your basic statement of cash flows. Now, under generally accepted accounting principles, the operating activity section of the statement of cash flows can be presented in either the direct or the indirect method. Now, the direct method identifies the specific sources and uses of cash. That's the statement that you've been looking at since chapter 1. And it looks pretty much like this, right? Cash receipts from customers, cash payments for expenses, and then net cash inflow $50. That's the direct method. The problem with the direct method for an accountant is you got to go back through the general ledger to find all these individual entries, add them up, and then put them in here. Now, the indirect method takes a different approach. It starts with the accrued net income from the income statement, and then it adjusts it for to convert the accrual-based net income figure to a cash basis. So here are the assumptions for a very, very simple example. Revenues of 500, expenses of 390, and net income of 110. Pretty basic. However, when we analyze this, what we find is New South earned $500 of revenue, but they only collected $400 in cash. This $100 increase in accounts receivable must be subtracted from net income, because what it's saying here is we credited revenue for $500, which went into net income, but we only collected $400, not $500. So we need to reduce net income by that $100 increase in accounts receivable that didn't represent a cash inflow. Number two, they incurred $390 of expenses, but they only paid $350 in cash. So again, we have a situation where we affected net income. Here, we reduced net income by $390, but we only paid $350 in cash. So this $40 increase in accounts payable must be added back to net income. So when we do those both items, what we come up with is a net cash inflow from operating activities of $50. So that's our statement of cash flows. The following section of this chapter examines the relationships between items reported. This is the reconciliation approach. We're going to look at a couple of examples, and this method works for all three sections. So, the beginning and ending balances appear on the balance sheets. The increase due to revenue recognized on account is the sales revenue. So we have a beginning balance of accounts receivable of $1,200. We increase accounts receivable for recognized revenue of $20,006. We have an ending balance of accounts receivable of $1,000. So when we do the math here, what we find is that we had a decrease to accounts receivable of $20,008. That's a $200 decrease. That means that we collected more cash than we billed for that month. For interest receivable, we had a beginning balance of $300. We had an increase due to interest revenue recognized on account, and we had an ending balance of $400. So 300 plus 7 is 1,000, minus 400 tells us that we collected $600 of interest receivable. So we increased the revenue by $700, but we only collected $600 in cash. So we had a $100 increase in this receivable. Again, we have a beginning balance of inventory here of $8,200. Now we recognized cost of goods sold of $10,500, and we had an ending balance of $8,900. What that says is we must have increased inventory by $11,200 of purchased stuff, which means we had an increase of $700 in inventory. And for accounts payable, since we're assuming that all of accounts payable is referenced to inventory, the beginning balance was $1,100. We bought $11,200 more. That's what we looked at before. And we had an ending balance of $800, which tells us that we settled accounts payable rather, for $11,500. So we increased it by 11.2, decreased it by 11.5, so there was a net decrease of $300 in accounts payable. So this kind of reconciliation analysis leads to 4 simple rules for the statement of cash flows. Rule number 1, we're going to add decreases and subtract increases in non-cash current assets, adding to, obviously, net income. These are the adjustments to net income. Rule number 2 deals with current liabilities. It says we're going to add the increases and subtract decreases in non-cash current liabilities. Rule number 3 is going to say that we're going to look at non-cash expenses like depreciation, and we're going to add those in. Now, if you think about depreciation, we recognize the cash effect of buying an asset when we set up the asset, right? If we buy a truck, for instance, there's a debit to truck and a credit to cash. There's no expense recognized there, and this we talked about in Chapter 8. This goes to depreciation, right? Depreciation is the periodic recognition of the expense of a long-term asset. So depreciation is not a cash expense, but it does reduce net income. So we're going to add non-cash expenses back. We're going to add back depreciation. And rule number 4 says we're going to add back losses and subtract gains. And that's the same reason, because losses and gains are book entries. We recognize the cash received on the sales of assets in the investment section of the statement of cash flows. And that's what we're talking about here. Because non-cash expenses are deducted in determining net income, they must be added back to the amount of net income when computing net cash flow from operating activities. Because gains increase net income and losses decrease, but neither represents the amount of cash received from an asset sale, gains must be subtracted from and losses added back to net income to determine the net cash inflow. So when we go through, and this is just we looked at a couple of these transactions. These are all of the transactions that are shown in the PowerPoint presentation. Notice we have a rule 1, that affected the decrease in accounts receivable, and that's why we're adding it back. Rule number 1 for interest receivable, it increased, so we're going to subtract it, and so forth. So here are each one of the rules and how they affect what happens on the operating activity section of the statement of cash flows when using the indirect method. And that's our presentation for here.